You are about to hear a sentence that scares most first-time investors. You are approved, but you need a lot more cash than you thought. And that is exactly why so many people quit before they even start. But here is the twist. There are a few legal, common ways people buy their first investment property with far less stress, and sometimes far less cash than beginners assume. In this video, I'm going to walk you through the exact step-by-step path from zero to financed. And near the end, I will reveal the #1 reason lenders say no even when the property looks like a good deal, plus the simple fix that can flip a no into a yes. Let's turn I want a rental into I own a rental without doing anything shady, risky, or confusing. Number 1, pick your first deal type before you pick a house. Most beginners do this backward. They scroll listings first, then they try to force financing to fit. Instead, start with the deal type, because financing changes based on what you buy and how you plan to use it. Here are 3 beginner-friendly options. Option 1 is a single-family rental. Simple. 1 unit, 1 tenant. Straightforward. Option 2 is a small multi-unit, like a duplex, triplex, or fourplex. More income streams, more stability if 1 unit goes vacant. Option 3 is the live-in first strategy. You buy a home, live there as your primary residence, and rent out extra rooms or extra units if it is a multi-unit. This can unlock better loan terms, but only if you truly live there. Example: Maya wants her first rental. She sees a duplex. If she buys it as a pure rental, she likely needs a bigger down payment. If she buys it and lives in 1 unit, she may qualify for a lower down payment owner-occupied loan, and the rent from the other unit can help her budget. Pick the deal type first, then you shop with a plan. Number 2, know the 4 numbers lenders secretly care about. When a lender looks at you, they are not judging your dream, they are judging your risk. 4 numbers drive most approvals. Credit score. Higher usually means easier approval and better pricing. Debt-to-income ratio. This is how much monthly debt you already have compared to your income. Many loan systems can allow totals up to about 50% in some cases, but lower is safer and often easier. Down payment. For many conventional investment property loans, down payments often land in the 15 to 25% range, depending on the property and your profile. Cash reserves. This is the money left after closing. Many lenders love to see you can cover several months of payments if something goes wrong. Example: 2 buyers want the same rental. Jordan has a solid score and low debt. He brings 20% down and still has 6 months of payments saved. Taylor brings 20% down but has almost nothing left. Jordan looks safer. Jordan often wins. If you only remember one thing, remember this: lenders fund safety. Number 3, build your down payment plan without losing your mind. Let's make this practical. Most people think they need a massive pile of cash. Sometimes they do not, but you do need a plan. Break your cash goal into 4 buckets. Bucket 1, down payment. Bucket 2, closing costs. Bucket 3, initial repairs and updates. Bucket 4, reserves. Example: you target a $250,000 rental. If your down payment is 20%, that is $50,000. Then you might plan additional money for closing, repairs, and reserves. You do not need to guess perfectly. You need to be prepared. How do beginners build this faster legally? Automate savings weekly. Cut 1 big expense, not 10 tiny ones. Increase income with a temporary side hustle. Use a slow timeline on purpose. 6 to 12 months of focused saving can change everything. The goal is not to rush. The goal is to buy and sleep at night. Number 4, get pre-approved the right way, not the useless way. A pre-approval is supposed to be your green light, but many beginners get a weak one. A real pre-approval usually means the lender looked at your income, debts, and credit, not just a quick estimate. Here's the step-by-step. Gather pay stubs, tax returns if needed, bank statements, and ID. Let them pull your credit. Ask what loan programs you qualify for. Ask what down payment they expect for an investment property and what reserves they want. Then ask the most important question. What would cause this to get denied later? That question is gold. Example, a lender says you are pre-approved. Then you ask, what could kill this deal? They say, if your debt to income rises, or if the property cannot appraise, or if you cannot document the funds. Now you know exactly what to protect. Number 5, understand the main loan options for a first rental. Most first-time investors use one of these paths. Conventional investment property loan. Common, often requires a larger down payment than a primary home. Owner-occupied loan with a live-in strategy. If you truly live there, you can sometimes access lower down payments than typical investment terms. The key is honest occupancy. FHA for a multi-unit live-in strategy. FHA requires the home to be your primary residence, typically for at least 1 year, and you usually must move in soon after closing. VA for eligible veterans. This can be powerful for house hacking, but only for those who qualify and intend to live there. Portfolio or local bank loans. Some local banks keep loans in-house and can be more flexible, especially with strong reserves. Example, Chris wants a straight rental. Conventional might fit. Anna wants a duplex and is willing to live in 1 unit. Owner-occupied financing might fit better. Same property type, different plan, different loan. Number 6, the rental math that makes or breaks your approval. Here is where beginners get tricked. They fall in love with the purchase price, but the lender and your future self care about cash flow. You need a simple first-pass formula. Monthly rent minus monthly payment minus monthly operating costs should leave breathing room. Operating costs include things like property taxes, insurance, repairs, maintenance, vacancy, and property management if you use it. Now let's talk about a concept lenders and investor loans often use, DSCR, or Debt Service Coverage Ratio. It compares the property's income to the debt payment. Many lenders like to see a minimum around 1.2 to 1.25 on DSCR-style loans. Example, if your total monthly mortgage payment is $2,000, a DSCR of 1.25 suggests the property income would be about $2,500 a month. That cushion makes lenders feel safer. Even if you are not using a DSCR loan, thinking this way protects you. Number 7, how to make your offer strong without overpaying. Financing is not just about getting approved. It is about winning the deal. A strong offer does not always mean the highest price. It often means the cleanest plan. Do this. Get your pre-approval ready. Show proof of funds for your down payment. Choose a realistic closing timeline. Avoid weird demands that slow everything down. And always protect yourself with inspection and financing contingencies that make sense for your market and risk tolerance. Example, 2 offers come in. One is slightly higher but full of uncertainty. The other is slightly lower but has clear financing, clear funds, and a smooth timeline. Sellers often choose certainty. You win deals by looking like you will actually close. Number 8, the appraisal trap and how to avoid it. This is a silent deal killer. If the appraisal comes in low, the lender may not finance the full amount you planned. Then you have 3 options. You negotiate the price down, you bring extra cash to closing, or you walk away if the numbers stop working. How do you reduce this risk? Do not overpay for a property that has no comparable sales to support it. Be cautious with unique homes that are hard to compare. Focus on neighborhoods with active similar sales. Example, you offer $260,000, but the appraisal comes in at $245,000. The lender finances based on the lower number. Suddenly, you need more cash. If you cannot bring it, you renegotiate or you exit. This is why investors say, you make money when you buy, not later. Number 9, the truth about repairs, reserves, and the ugly first month. The first month after closing is where dreams go to die if you are not prepared. A tenant moves in late. A water heater fails. The property needs something you did not notice. This is why reserves matter so much. Some lenders explicitly want reserves, and you should want them too. Create a simple system. A repairs fund that grows every month. A vacancy fund that covers at least 1 month of rent, ideally more. A separate account so you do not accidentally spend it. Example, your tenant pays rent. You automatically move a slice into reserves. Over time, your property becomes less stressful because problems become routine, not emergencies. Real investors do not avoid problems, they budget for them. Number 10, smart ways to use equity and refinance later. Now we talk strategy. Many investors start with one loan, then reshape it later. Here are ethical, common moves. Refinance when the property is stabilized, meaning it has consistent rent and you have a track record of payments. Cash out refinance cautiously if the numbers still work and you keep reserves. Home equity line of credit on your primary home, if you already have one, used carefully and only if you can handle the payment even during vacancies. Example, you buy a rental that needs simple updates. You improve it, raise rent responsibly, and stabilize it. Later, refinancing could lower your payment or free up cash for a second deal. This is not magic. It is patience plus math. Do not chase leverage just to feel fancy. Use it only when the deal can breathe. Number 11. Alternative financing. Beginners hear about it. Explained simply. You will hear these terms. Let's make them clear. Seller financing. The seller acts like the bank. You pay them monthly. This can work when the seller owns the home free and clear and wants steady income. Contracts must be solid and legal. Private money. A person lends you money, often short-term. This can be risky and expensive. Beginners should be careful and get proper legal paperwork. Hard money. Asset-based loans, often for fix and flip style deals. Usually higher cost, not ideal for most first-time buy and hold beginners unless you truly understand the exit plan. Partnerships. You bring the deal or the work, a partner brings the cash or credit. This can work, but only with clear written agreements. Example, Sam finds a great property but is short on cash. Instead of panicking, Sam partners with someone who funds the down payment in exchange for a split of profits, with a written agreement that spells out what happens if repairs go over budget or if someone wants out. Clarity protects friendships. Number 12, the biggest approval killer and the simple fix. Remember the promise from the beginning. Here is the number one deal killer that surprises beginners. It is not always the credit score. It is not always the down payment. It is unstable income and messy documentation. Lenders want clear, provable income. They want clean bank statements. They want to see where your funds came from. They want fewer question marks. The fix is boring and it works. Keep your job stable during the loan process. Do not open new debt right before closing. Avoid large unexplained cash deposits. Move money between accounts carefully and document it. Keep your paperwork organized in one folder. Example, you are 2 weeks from closing. You decide to finance furniture, open a new credit card, and move money around without tracking it. Your debt to income shifts. Your bank statements look confusing, and the underwriter hits pause. The deal becomes stressful for no reason. Be boring until you close. Then celebrate. Number 13. Shop interest rates like you shop the property. Many beginners spend weeks hunting a house and about 5 minutes choosing a lender. That can cost you real money. Rates, fees, and terms can vary even when your credit looks the same. Here is the simple move. Get quotes from at least 3 lenders. Ask each one for the same scenario, same price, same down payment, same loan type. Then compare 3 things: the interest rate, the closing costs, whether the rate is locked, and for how long. Example, you are buying a $300,000 rental. One lender offers a lower rate but high fees. Another offers a slightly higher rate but much lower fees. The cheaper monthly payment is not always the cheaper total cost. A quick comparison can save you thousands over time. And one more thing, rate locks matter. If your closing gets delayed and your lock expires, your payment can change. Know the lock length before you go under contract. Number 14. Get the right insurance before a single tenant moves in. If you use the wrong policy, one bad event can turn into a financial nightmare. Investment properties usually need landlord insurance, not regular homeowners insurance, because the risk is different when a tenant lives there. You also want to think about liability coverage, because accidents happen.
Example: a tenant slips on icy steps. If you have weak coverage, you might pay out of pocket for something you never saw coming. With proper coverage, a scary moment becomes a manageable claim. Also, if the property is in an area with floods or storms, ask about extra coverage early. Do not wait until the day before closing. Number 15. Decide who manages the property, you or a pro. This decision changes your life more than your down payment. Managing yourself can save money, but it costs time, energy, and stress. Hiring a property manager can reduce headaches, but it costs money, and you still need to oversee the manager. Here is a simple way to choose. If you live close, have flexible time, and want to learn, self-managed can work for your first property. If you live far, have a busy schedule, or hate emergency calls, a manager can be worth it. Example: Ethan self-manages his first rental. He learns how leases, repairs, and rent collection really work. After a year, he buys a second property and hires a manager because he now knows what good management looks like. If you hire a manager, ask how they screen tenants, how they handle late rent, and how repair approvals work. Number 16. Tenant screening that protects you without breaking rules. The tenant you choose can make the property feel like a paycheck or a problem. So screening is not rude, it is responsible. But you must do it fairly and consistently. A simple beginner system looks like this. Use the same application for everyone. Verify income and employment. Run credit and background checks where legal. Call previous landlords if possible. Use clear written criteria and apply it the same way every time.
Example: 2 applicants apply. One has stable income and strong rental history. The other has income that is hard to verify and a pattern of late payments. If your written criteria says you require verified income and no recent evictions, the decision becomes simple, not emotional. Consistency protects your wallet and keeps you on the right side of fair housing rules. Number 17. Your renovation plan should be boring and profitable. Many beginners hear fixer-upper and imagine a makeover show. That mindset can wreck your first deal. Your first investment property updates should focus on safety, durability, and rentability. Think boring wins, floors that handle wear, paint that looks clean, lights that work, plumbing that does not leak, heat and cooling that is reliable. Example: you have $5,000 to improve a rental. A fancy backsplash is fun, but fixing old plumbing and replacing worn flooring prevents emergencies and makes the home easier to rent. Your tenant does not pay extra rent for your favorite tile. They pay for a clean, safe, functional home. Get at least 2 or 3 contractor bids when possible. If one quote is wildly low, it may be missing something. Number 18. Build a tiny team before you need them. Beginners often wait until a crisis to find help. That's when you overpay and make rushed decisions. Build a small team early. A real estate agent who understands rentals, a lender who communicates fast, a handyman or contractor you can trust, a local insurance contact, a real estate attorney in your area if needed.
Example: your tenant texts at night, "The water is leaking." If you already know who to call, you solve it quickly. If you do not, you panic, you search, and you might hire the first person who answers. A team turns emergencies into routine tasks. Number 19. Know the closing paperwork that can surprise beginners. Closing day can feel like a blur,
but one mistake can lock you into costs you did not plan for. Here's what you want to understand in plain language. The loan estimate early in the process, it shows projected costs. The closing disclosure near the end, it shows final costs. The title report, it shows if there are liens or issues on the property. And your monthly payment breakdown, principal, interest, taxes, and insurance. Example, you expect one monthly payment amount, but the final numbers include higher taxes than you planned, so the payment jumps. If you review the closing disclosure early, you can catch surprises before you sign. Ask questions until it makes sense. Confusion is expensive. Number 20. The simple landlord money system that keeps you from going broke. Your rental is not just a property, it's a small business, and small businesses need simple bookkeeping. Do this from day one. Open a separate bank account for the rental. Track every income and expense. Keep receipts and notes for repairs. Set aside money for repairs and vacancy every month. Example, 1 month of vacancy isn't just annoying, it can wipe out about 1/12 of your annual rent, roughly 8%. That's why systems matter. When vacancy happens, your reserves cover it and your personal life stays calm. This is also how tax time becomes easy instead of stressful. Your numbers are already organized.
You do not need to be rich to finance your first investment property. You need a plan, a clean financial profile, and a property that actually works on paper. Start by choosing the deal type. Build your cash buckets, get a real pre-approval, run the rental math, protect yourself from the appraisal trap, keep reserves, and stay boring during underwriting. And remember, your first deal is not supposed to make you feel like a genius. It is supposed to make you feel stable. If you are planning to buy your first investment property in the next 12 months, what is your biggest obstacle right now? Down payment, credit, income, or finding a deal that cash flows? Tell me in the comments.